Let's take a look at problem 4-2, which is a problem involving discontinued operations. Now, on the left part of the screen where I'm pointing to now, you can see the information that they've given you. We've got condensed income statements for Jackson Holding Company for 2012 and 2013. Now, on October 15th of 2013, Jackson entered into a tentative agreement to sell the assets of one of its divisions. And I'm just reading to the left of my mouse here. Okay? The division qualifies as a component of the entity as defined by GAAP. The division was sold on December 31st, 2013 for $5.3 million. Book value of the division's assets were $4.6 million, and the division's contribution to Jackson's operating income before tax for each year was given, as you see here, $450,000 loss in 2013, and the year before it was a $350,000 loss. Okay, now we're to assume there is an income tax rate of 20%, and the requirement is to prepare the revised income statement according to generally accepted accounting principles, beginning with income from continuing operations before income taxes, and you are to ignore earnings per share disclosures. Now, on the right side of the screen, you see the solution given this set of numbers. And there's an explanation on the bottom right here that shows how we came up with the numbers. Okay, so the first number we're entering is income from continuing operations before income tax. Well, where do we get that $3,150,000? Right from here. We took the unadjusted income from continuing operations. I'm looking at 2013, right? There was $2,700,000 of unadjusted income from continuing operations. That comes from right there to the left of my mouse. Then we have to add that loss of discontinued operations. They gave that information right here, $450,000. So we add that and we come up with an adjusted income from continuing operations of $3,150,000. That's where that comes from. Okay, the income tax rate is 20%. We add that, or if you will, subtract it to come up from income from continuing operations. Now, you use the same logic for the year before, and the other item you need to consider is the gain on disposal. And they provide that $700,000 right here. There was a gain on the sale of the division. That's our gain on disposal. So for income of continuing operations, we've got the actual loss that was given as $450,000, and we have to show the gain. Okay, so the net loss, let's just look at 2013. We had a gain of $250,000 in 2013. That $250,000, the loss from the operations plus the gain makes its way right there to income from operations of discontinued component, and then we need to consider an income tax benefit or loss if there was one, right? And that gets us down to the income or loss on discontinued operations. Okay, that's the explanation with some hints as to how you solve this. Feel free to pause this presentation as you think through this problem.